Hey there, it's Phil Ratcliff and Tony Jones. We're going to do our own internal live broadcast today to talk about some fun tax stuff, right?
Exciting stuff, yes.
Hey, we worked hard this morning twerking this around a little bit to make it like practical to regular people and hopefully not boring, right? But it's important, right? We all got to pay taxes or at least participate in the system. And if you do it right, you'll be better off.
Could be a lot of money.
Yeah. So I'm going to pass it off to Tony. Tony is our enrolled agent. He's going to explain the different types of tax preparers and what's out to you a little bit as well. But he's our expert here. So go with it, Tony.
So we're going to rely on Eileen here as we bounce back and forth between the slides and ourselves here. So let's go to the slides here, the presentation. So the first one I'm going to talk about, just most people know what a CPA is and a regular tax preparer, but I'm an enrolled agent. So, here's the definition, but basically it's a certification I had to go through with the IRS to become an enrolled agent, and then background check and things like that. So it's in no way them, saying, hey, we endorse Tony Jones. It's not like that, but I did pass qualifications to get.
And it's a lot. I remember as you're going through that whole process, it took a long time, and there's huge books. I mean, so it's not like a notary to where there's like this little teeny pamphlet and you take a 1-hour test and then you're a notary, right?
Yeah,
I mean,
right.
You had 3 huge tests that go over most of the tax code. Right?
Yeah. And I have done taxes in the past, and I have an accounting degree, so I'm familiar with things, but it was a difficult test. So anyway, so here, let's jump into some of the different things that we're going to talk about. The first one, as we talk about changes. Now, there's a lot of changes, right? But we have to decide what we're going to talk about. So the first one is going to be itemized for standard. And I try, not everybody understands this, but basically you get to pick one of these deductions, okay? And in 2017, the standard was about $12,000 for a married filing jointly. It's half for others, right? And so if you eclipse that, you would then take the standard deduction. But most people don't eclipse it by too much if they do at all. So one of the benefits this year was that they doubled basically standard deductions. So even though you may not have qualified a lot with your itemized deductions, you now got a doubling of the deductions. However, you also lost exemptions. So that was last year, like in 2017, $4,000 per person. So 6 people in my household, that was like $24,000 lost. So it works great for some people, others it doesn't. So, but I just want to make that important distinction that you get one or the other. One of the other changes I'd like to talk about, because a lot of what I'm talking about today has directly affected some of our clients, so it's kind of top of mind. The fact that you can't, if it's an unreimbursed employee expense, with almost without exception, you can't write it off. And in previous years, you've been able to. The biggest one, and the one that comes to mind, is mileage, right? You can't. It used to be that you could.
And home office too, right?
There's home office, qualifications and things like that. It's not in most, right? Most everyone. The home office is a big one too. But anyway, that's one. So the other thing I'm going to make, and really I shouldn't have this under changes, but I have it down here. I just want to advise people that when you're contributing to your IRA and HSA, and many of which do it outside of the, our firm when they're our clients, just make sure you're doing it right, because I've had to go back to clients and say, you did too much back in 2018, put too much in the HSA, you put too much in the IRA, so just make sure.
Some people think that their employer's going to make it right, or what's and that there's a system in place. And a lot of times there is, right? But I think one of the circumstances we ran into is where both spouses had different employers, and how would one employer know what the other employer? They wouldn't, right? So like, who's responsible for that?
That's exactly right. I mean, you could have numerous IRAs, and wherever each custodian's not going to be able to track how much you've put into the other one. So anyway, just something to be cognizant of. Something else I want to talk about, because this is a little puzzling to people. You heard back in early 2018 that tax rates were better and we shouldn't be paying more taxes. But something also happened at that time, and that is that the government said, let's withhold more from everybody's taxes so that we put more into the economy and we could generate a little stimulus, okay? But of course, once you get a couple paychecks, you become accustomed to that and, acclimated to that amount right away. And so what happens now is Yes, in some cases you owe less money, but what you go to find out is over the course of the year you've had less withheld. And so even though you owe less, I mean, even though you owe less overall, that doesn't mean you're going to get more back. It might even mean that you're going to pay some, which happened to me. In fact, we always got a little back, but this year we have to pay a little bit. So even though the withholdings were lower. So
well, that's difficult for people to understand. They're like, well, I thought the Trump tax cuts said I was getting more money. And for most people, they did, right?
Overall, yeah.
But you spent it.
You spent
you
it.
spent it already.
You got used to it.
You didn't know it.
Yeah, you
didn't know it.
And so we're having our advice is, go depending on, a lot of people use that as a forced savings a little bit. There's different ways to go about it, as we talked about, and we're going to talk about that a little bit. But you can go back to your company, ask them to withhold a little bit more if that's what matters to you. So, and then you'll have less of a tax bill or get more back next year. Okay, so. Now we're going to go into some of the credits, all right? And so we're going to list a handful of credits here. This is where the average Joe has an opportunity to lower their tax bill, okay? The first one I'm talking about, because it does more than that, is the saver's credit, and it's probably the least used, I think, out of all of it.
It's a sad, sad thing.
Yeah. I mean, I wrote, I drummed up some numbers, and you could actually get to the point where you could build up a healthy retirement if you're a low-income person by putting less than $1,000 away, just because of a match of a 401k possibly and the saver's credit. So it's not just you putting in your 401k; it could be your employer and the government as well. So it might be up to 50% of credits. You get a credit
10, 20, and 50, just depending on
different categories. But you top out, if you see the numbers below here, at 31.5 in 2018.
Adjusted gross income. So it's not your gross income. So a lot of people think, well, I make $35,000. I don't qualify for this.
Yeah.
Right? But that may not be the case.
Right. It could be that you contribute money to your 401k, which then lowers to get you qualified. So it's kind of a double whammy by putting away. But it's a great way for people to really get started when it seems unaffordable to them and they need to.
So yeah, if you get that 50%, you put $1,000 into the 401k. Say the employer, matched in $200 on that. And then the government, when you file your taxes, gives you a credit of $500 back. So it's like you got like a 70% match in that circumstance.
Right.
That's like phenomenal. Now you have to pay 1 year basically like ahead, but then after that, when you get the money back, you can keep rolling it forward to where it's not costing you anything, and you're getting, basically free money into your retirement.
Right.
So that you'll be able to retire sometimes and not have to work the rest of your life for money. One day your money can work for you, and you won't be destitute.
Well, here's another way to look at that. We talked about people who like getting a tax refund, so they want to increase their holdings. Here's a way to help yourself get a bigger tax refund without increasing your holdings. Put it into your 401k and just check to make sure you make the qualifications, but that might be a way that works out for you. So anyway, an important one that people miss. Another one.
And just to throw it out there, if you're in that situation, you should almost certainly be saving Roth, not pre-tax. All right, so just remember that. Roth. All right.
Yeah. So, okay, then here's another one, the child credits for 2018. It doubled from 2017 to a maximum of $1,000 to $2,000. And it's more refundable this year. Refundable meaning that even if you don't owe taxes, you might be able to get something back. But there is some of it that's, it might be non-refundable too, depending on your situation. And the limits have really gone up. In 2017...
Well, what you're really talking about there is before, if you get a tax credit that went over your tax bill, you just got paid, right?
Right.
And when we're talking about refundable, non-refundable, if you're due the credit and you haven't paid that much tax, you don't get it, right? On the non-refundable.
Well, refundable means you can go below zero.
Yes.
Right?
That's what we're talking about. I just would like put it in layman's terms
Sure.
for people. It's like, hey, if you put in, you paid $4,000 in taxes and, child tax credits like $6,000 or something like that, you may not get the extra $2,000 back if you didn't have tax to pay, depending on your circumstances.
If it's non-refundable.
Okay.
Yeah. So using married filing jointly as an example, it started to phase out at 110 in 2017, 400,000 in 2018. So that went a lot higher. 16 and under, that's who qualifies for it. I know that very well because I had 3 kids in my household that turned 17 in 1 year, so I lost them all at the wrong time. So anyway, so it's a great one though. You just have to have the child. That's it, and then meet these qualifications, and you get the credit. So let's talk a little bit about the earned income credit one. So it can be a credit up to $6,341. The point of this is, and this has been around since like 1970, is that we want to encourage people, even if they're lower income, to work. And so this is a way to offset that. And it goes all the way up, if you're single, to $15,270, and then married filing.
And it goes up higher the more kids you have too, right?
Yeah, you have to. Yeah, there's. And I'm just trying to. It's hard to weave all this in, but Phil's right. I mean, how many kids you have will come into play here. So keep that in mind. But just know that if this is you, and you got a family, then you might have an opportunity.
Say it pays to work, right? But this one, you can only get the child tax credit or the intern. You can't stack them up, right?
In some cases, you can get both, I believe.
Oh, okay.
So I'm not. I know what you're saying because we talked about that, but I thought you could get both. So, well. So another one, the Childcare Credit. Child has to be less than 13 years old, okay? And really this is for care of the child, when you put the kid in daycare.
It's getting expensive. There's a lot of studies out saying that the child care now in many states is more expensive than college. It's crazy, isn't it?
Oh yeah, it is. I mean...
I think that was one of Christy's posts that she found, and I couldn't believe it.
It is expensive, right? So the credit could be anywhere from 20 to 35%, if you qualify, up to $3,000, and it's a percent, like we said, 20 to 35%, up to $3,000 for single and $6,000 for married filing jointly. Okay, so just be cognizant of this. Save the money you spend on childcare, but you're also going to need an identification number of who's doing the care, an address and name and things like that. So the last thing I put down here along these lines was a flexible savings account. And what that is something you do through work if it's possible. And basically it goes in there before taxes, then you could pay bills with it. You just can't overlap on the credit in that money. But these days, the FSA is up to like $5,000. So there's a good chance you're going over that anyway, and you're going to get to use more than that. So anyway, that's a little bit about that. But also, it isn't just for, this, I'm going back when I had this in a bad order here. But if you are taking care of anybody, a dependent, you can still have a $500 credit for each of those people. So even for senior citizens, or in my case, for 17-year-old kids, okay? And so it's up, you have it up until, as a single person, phases out once you start to make $200,000 and $400,000 married filing jointly. So there's always other rules with all these things as how they tie in together and such. So always be cognizant of that. But we just want to give you some indication. Education credits. Okay, this is one that a lot of people overlook because there is opportunity here. So the first one we're going to talk about is the one that is used when you're in doing undergraduate work for 4 years. So it's actually up to $2,500 in college tuition related expenses qualify for the cost of what can be credited. $80,000 for single, $160,000 for married filing jointly. 40% of this is refundable. So going back to what we said, you can go below zero with some of this, not all of it, but some of it. And again, as I mentioned earlier, it's meant for those in undergraduate, so 4 years of college. So if they go 5 or 6 and that's undergraduate, that doesn't count, okay? You get those 4 years. So you want to be thinking ahead of time about how somebody might be going to school. And let me go in a little further than that, because there is another credit, and it's called the Lifetime Learning Credit. Oops, I went too many here. And so this is different. This is for your lifetime, as it says. And so 20% up to $10,000, and it's not that straightforward, but that's the gist of what it looks like. You start getting away from qualifying at 67 for single, 134 for married with double. And what I mean by no double dipping, you either get the American Opportunity per person or the Lifetime Learning Credit. You don't get both in the same year, all right? And as I mentioned again, there's a Lifetime Learning Credit. So
you're going to use the American Opportunity generally for community college or undergrads where you get an associate's or a bachelor's degree, right?
Yeah.
And then the lifetime learning credit you could use anywhere, but maybe if you're using those American Opportunity first, maybe for grad school, if you were going to go to grad school, or you're just at a really expensive undergrad school, you would sub that for 1 year.
Yeah.
To be able to credit higher.
Right.
Yeah.
Well, and to add on to that, though, as you're planning, I went to, while I worked, I went to a junior college for 2 years, then I went to Indiana for 3. So that's 5 years, and I'd want to use the American credit for the last 3 for sure, because that's going to be a lot more tuition than the junior college. So you want to give thought to what you might be doing. If you're really just kind of dabbling in college, even if it's 3, 4 classes and you don't know for sure what you're doing, but you know you're going to go to college, well, then maybe the lifetime learning credit might be better for you. So something to think about. So, okay. But the point is, there are a lot of good credits that can help middle-class folks, low-income folks on their tax bill. So just be cognizant of these things. What I find often is that people miss, what they don't know what they don't know, and so they're often missing these opportunities. We use Drake tax software, and it's very great. It's great at alerting you to what is available, but it can still be missed if you're not.
And people can miss a lot of things too, in terms of how you engineer how you're using money. So you'll have people that say, well, I want to do this big project and I just want to pay cash for it, and I'm going to get this big bonus, I'm going to pay for it. And if they would have taken that bonus and put it in deferred compensation at work and taken some of their money or borrowed off their line of credit, they would have got a credit that they would have phased out for by just realizing all of their income. So some people are just giving these things away when they don't have to.
Right. When it's there for them.
Yeah.
Yeah. Mm-hmm. So there's ways to plan around with that. So just be cognizant of it and think about, going in. Now it's 2018, right? We're only into March. There's still an opportunity to think about it. I'm sorry, we're in 2019. So think about 2019. I'm in the tax year still. So think about ways that you can manipulate the system so it works in your favor and you can maximize the credits available to you. So the last thing I want to talk about, which is
it's last year for solar credits too, for
as of now, right? Hopefully we keep
for regular people. Businesses get an extra 2 years or something, right?
Yeah.
So if you want to get some solar panels, as long as Trump's tariffs aren't holding you down too much on the costs.
Yeah, and we will. I always tell people for sure, as we do long-term planning, is tax code's going to change in some capacity or another. So just take care of it while you can, or take advantage of it while you can. So the bane of my existence while I'm doing taxes is the local taxes, and that's why I made a slide here. And this can be confusing for folks. So I just want to point out a couple things. If you've lived somewhere for a little bit, you are probably in good shape and not having to change anything. But at times, you either have to pay city, school district, or RETA, which is really city, or both, or a number of them, okay, depending on where you work and live. So it can be confusing because some jurisdictions will say you have to file no matter whether you owe or not, and some do not say that. Some will give you a tax credit. If you live in one city and work in another and you pay the full 2.5 that you owe in the city you work, then where you live is not going to ask for that. But some want it in addition to that. So you just have to be really cognizant of that. There's a lot going on. What I learned, RETA wants you to file taxes whether you owe them or not if you live in a city that uses RETA. But if you work in a city that uses RETA and not live in one, then you don't have to file.
So RETA is an organization that does taxes for lots of municipalities, right? Lots of cities and villages and so.
Right. Good point.
Instead of having to do tons of different ones, a lot of times they can reconcile for the ones that they do, but I'm sure they take a cut. That's why some of the bigger cities probably don't use the RETA, right?
Well, so to Phil's point, I didn't say that. Regional Income Tax Authority, that's RETA. But that's how they make their money. So they're also going to be a lot less lenient when it comes to, it seems to me, when they're working things out with folks. I would go to your city if you have an issue with RETA and say, look, what can I do here? Before you go to RETA, if it's a bad problem. So that's that.
Hopefully you don't have bad problems with tax.
Yeah, right. But I'll tell you what, the most confusing one at times can be just knowing who to pay for your local taxes here in Columbus, and it can be anywhere. Yeah, that's true. That's really Columbus. So I do want to say, we forgot to mention, if you have a 360 by chance, you might want to spin that around and just look for.
All right, man, quit giving away our stuff.
I want people to spin a little bit.
All right, so yes, we do have 360 video. If you're watching this on the regular, like we do 360 video, you can watch. It's a little grainy now because when we're streaming live and it's doing the entire room up and down and all around and everything, that's a lot of stuff. So once we get over 100 viewers, we'll get us a live 4K and then recorded 8K. So right now we do live 1080p, and then we will record and post the 4K later. That's just how good the quality is. Hopefully most of you guys get it because people are buying TVs all the time. Right now we can all afford them. Yeah. The prices come down, but the 360 is going to be the future. So if you're watching that, you can see everywhere around here. We might or might not be putting Easter eggs that Tony's trying to give away. So it is hopefully in the future going to be our preferred way to watch this. Check it out. We got a totally different 360 channel for that. So it's really cool if you haven't seen it. And now they're making a lot of cool things like Samsung and Oculus and all of them making different VR, AR, or even take your phone and put it in this nice, not just the crappy ones that they used to make, to where you can actually experience things. Like this, so like you feel like you're there, like you're a part of it. So yeah, check it out. So our website's rftax.com. Tony is really building us up to where we're doing great taxes in-house now. We have two really good partners as well, Harper & Company and HBK. So when things are more complex, or business owner where they might need multiple specialty CPAs or a tax attorney, then we refer out our clients. Or so that we still very much appreciate our CPA partners, but we are trying to make tax advice and planning available to middle class and even lower, to where in the past you would just have to go to H&R Block or Liberty or TurboTax, and who knows if they're really like when they're just like, oh, here, we'll give you your tax return now, and then when we get it, you're good. But what are they charging, like 20 or 40% or something like that? It's like a payday loan. It's like ridiculous, so like they're definitely not on your side. So anyways, that's the reason why we've kind of built this out. We tried to make this so that we could give you some ideas, no matter where you are out there, try to make it a little bit easier to understand. We're going to be building out this website, rftax.com, so check it out. We put stuff up here. Our enrollment is closed this year. We close it off pretty early because we need to know who wants to use this or not. But it's going to open again on August 35th. Or 31st. You've got to be a client for us to do taxes, but it kind of goes through there. They're our partners, Brett and Paul at HBK and Harper. Next year, we're going to make a payment page that like explains, like calculator wise, whether you want to use one of the partners or whether you use us, and based on what level of service and how much you have with us, it'll just tell you what the fee will be or if it's free, right? Because our goal is to try to like encapsulate everything. So taxes are going to keep changing. I mean, that's for sure. Obviously we can't keep running all these budget deficits and run up our debt to the ceiling, but so things are going to change, right?
They are always going to be changing in the tax world.
Going to change, right? And so we're here to help our clients and the people that we serve do the best that they can. We believe in kind of progressivism in terms of helping people. We want people to live better lives, do better with the resources that they have, and that's our whole goal in the world. So one last thing I wanted to mention here is we do or we call it rebel rousing. It's like our version of team building / happy hour / client event type thing. And if you go to our website, you can look down here. Like this is a way to get to us. You could just Google events rebel, and I think our Eventbrite page comes up, even just from that. And so when you look down here, like today, we're actually doing an escape room at Breakout Games down in Grandview. It'll be our second one. We had a blast. This one's going to be even bigger and better. But you can register for any of these that you want. If you're a client, we'd love to hang out, see you. If you're not and just want to meet us, that's great. If you're a business partner and want to get involved and just do something fun, this is a whole lot better than just going and sitting in a bar. Right. I mean, let's do something. So we're doing that escape room. Next week we'll have a poker night at our office. The next day, I actually have an open house at my house, like showing off solar panels and electric car and my crypto setup, so people can see that. Then we're doing VR gaming, Mario Party. We have a 5K coming up. We have a Sporting Clays event. We're getting a new office at the end of May. We're going to have an open house for that, so people can come check it out. Then our golf scramble. So we try to have things planned out a half a year to a year in advance. The majority of these are free. Some of them have some costs because we're not trying to pass that on to our clients. But we do everything at cost. We're not trying to make money off of this. So come out and check us out. If you have questions, give us a ring on tax stuff. Tony's awesome at it. He's busy right now, but
well, we're much busier than we thought we were going to be, but it's good. It's really the administrative part of it that we're really learning. The tax part, we're good handle on that. But so.
And if you are watching on 360, then William's helping him a lot with the taxes. You can see him back there. He's kind of our tech guru in here when we're doing these live broadcasts. So again, you're watching on 360, you get the inside view of things. So. Any last thoughts, Tony?
No, enjoy the last weekend of March here.
Hopefully it's a good spring. Enjoy it. So. Get rained on. Yeah. Well, we'll see you soon. Let us know if you have questions. And happy tax filing time.
Thank you. Have a good weekend.